Our first presenter, Hamed Shahbazi, is well known to everyone on the call as both the CEO and founder of WELL Health and as the creator of significant shareholder returns through his past success in the technology space. I would like to frame the transformative 2021 recorded by WELL as it is entering 2022 with run rate revenues and EBITDA approaching 450 million and 100 million respectively. These levels, not that long ago, entering 2021, were roughly 100 million with single-digit EBITDA margins. Now, this was ahead of WELL announcing its US $373 million offer for CRH. I am very confident that Hamed's presentation will present a bullish outlook founded on organic growth, supplemented by accretive acquisitions and strong execution. With this, I am very pleased to quickly hand it over to Hamed. Hamed, welcome and thank you.
Thank you, Rob. Really appreciate the introduction, you having us here. We're really excited to talk to the street. It's been obviously from a macro perspective an interesting start to the year with the rotation of growth to value. Despite us being known as a growth company, I think that given WELL's very strong momentum in cash flow generation and profitable growth, I think we're going to be very attractive to the value crowd here in 2022. So we're very pleased to talk to you. We're very pleased to talk about where the business is going. Again, we're very excited about where we're at. It's often like this where as there's macro sort of events going on and rotations going on, that affect your share price. At WELL, we believe we've never been a better company. We've never been executing better. We feel like we're firing on all cylinders. We think investors are going to be extremely proud of their company. And so, yeah, we're really happy to be here and talk about our progress. So let's go to the next slide. I think Amir's driving. Great. And to kind of center us back to what WELL is really about is to help healthcare practitioners be more successful, to bring them into that digital age and help empower them with all things digital. As the demands on healthcare practitioners grow, as the burdens grow, and as they have been growing, the enhancements in productivity that we provide through our platform are very, very helpful to them. So we're seeing an unprecedented number of healthcare practitioners seek digital productivity tools, whether that be electronic medical records or different apps that plug into those records. And WELL has one of the most complete platforms available, probably the most complete platform available in the country. We are number one in digital patient engagement, number one in e-referrals. We're top 3 in practice management. We're the largest owner operator of outpatient medical clinics in the country. We are really a very important foundational company now in the healthcare ecosystem, and outside of the government, really one of the most consequential businesses that support practitioners in the country. And to the extent those practitioners don't want to use our platform on an a la carte basis and source again, whether it's our practice management tools or our billing, again, we're number one in billing across the country too for outsourced billing service for doctors. They can now leave their practice and join us in our patient services business. So we have these 2 business models that unlock and provide value through our platform. So you can either use our platform directly, pay us for it, and implement it in your patient service business, or you can just join our patient service business as a doctor. You can focus on the medicine, you can focus on the patient, and we'll provide all those back-end services, all those people and process services for you. And that dual approach and being able to help practitioners in either mode is really working well for us. Next slide, please. And in terms of the numbers, again, the numbers have been very strong. 2021 was a consequential year for us. We made a couple of important acquisitions and a bunch of other tuck-ins as well. Our business is working remarkably well. Our revenue run rates are at or better than what we've been talking about consistently. Our EBITDA run rates, again, are on track and better than what we've historically communicated. And so we continue to be extremely bullish. At the center of the slide here, you have, again, the key metric. The centrifugal force of WELL is that healthcare practitioner. And we have roughly 2,000 of them inside the company providing care in our patient services businesses. This is where we provide, the back end, the front end, all the support services where they can be successful, and then we have 15,000 plus of those practitioners that are acquiring services on an a la carte basis from our platform. And even though the 2,000 number is smaller than the 15,000 plus number, it generates more revenue because we capture the full economic output of those practitioners, and are sharing into 20 to 40%, actually up to 50% of the economic output of a practitioner, depending on that, whether or not that practitioner is a doctor or a nurse practitioner or a CRNA. And then when those practitioners are sourcing our productivity tools, we're capturing much less economic output, but we're not as responsible for delivering and taking on risk for them. And that's, we're talking about anywhere from 1% to 4% of their economic output is captured there. So we love both. We understand that some practitioners really want to run their own business. We know that is becoming less and less likely that practitioners will want to run their own business because of the complexities and the challenges that digitization brings, that new regulations bring in terms of data protection and whatnot. And so we're seeing a lot of momentum in terms of practitioners wanting to join the WELL platform. And the other thing that we started to disclose and talk about in our Q3 financials, and we're going to continue to do that, is that WELL's revenue is highly resilient. Over 90% of our revenue, I think we mentioned roughly 93% of our revenue is either truly recurring, i.e. like SaaS recurring, or highly reoccurring in terms of the patient services volumes that continue to replenish with great predictability. And we also talked in Q3 about our aim as a management team to meet and exceed rule of 30, which is this concept of our organic growth percentage as a business, plus our EBITDA operating margins. If you add those two percentages together for those numbers to exceed 30. And in our Q3, we talked about how if you had taken all the assets and all the companies that we owned as of Q3 and you compared them on a year-over-year basis, you'd see an organic growth of roughly 14%, and we delivered great, operating EBITDA margins. And so, we feel like we're on track there, and we believe that there's some interplay there between EBITDA margin and organic growth. But we're a company that has cash. We are generating cash, net cash from operations. In Q3, I believe we generated about $8 million in cash, free cash flow from operations before investing activities, and that did not have a full impact or contribution from our MyHealth acquisition. So we feel really great about the fact that we are in a territory now as multiples come off in the market for M&A purposes. We think that we're going to have great opportunities to continue to grow with better capital allocation, and that's really a big part of the WELL business and spirit, is the capital allocation. And I think our revenue per share and our EBITDA per share is second to none in the industry. Next slide, please. So really what we've done in order to help the market better understand and track WELL is to segment the business broadly into what we call omni-channel patient services and virtual services. The only real difference between these two, these two areas is exposure to brick and mortar. In omni-channel, you have a hybrid approach. You have brick and mortar in addition to digital health and virtual care forms. For example, in our primary care business, we're still seeing roughly about 50% of the patient visits being delivered through virtual. And in specialized care, the same. In our My Health group, we still, as it relates to the actual physicians providing consultations, not the actual diagnostics, which of course have to be done physically, but the actual physician consultations, over 50% of those are also still delivered virtually. And so they're in our, and so that's not a true brick and mortar business. That's a hybrid business, which is highly resilient. And again, whether or not there's a pandemic, it's delivering great service and growing nicely. And our virtual services bucket is little to no exposure to brick and mortar at all. So here you have all your SaaS tools. This is where you have all your platform components, and then any patient services businesses that again that are either purely digital, like our WISP business or our telehealth business or our Circle Medical business, which again is the vast majority of that Circle Medical business is now digital. So we put them in that virtual services bucket. The idea being is that you can sort of track the company's growth. And as you can imagine, you have a much more scalable and faster growing business line of business in virtual services. I think in our previous disclosure and communication, we've noted that that business is over $100 million business and growing at over 50% organic growth, and it's profitable. So again, there's nothing really like that out there. And then our omni-channel patient services business is much bigger and much more profitable, but slower in terms of organic growth, but growing nonetheless and highly resilient. Next slide, please. We've covered some of this already, but again, omni-channel patient services group again includes our primary care, our allied health, all the different integration and enhancement that we've done to our primary care platform, our specialized care group, which includes now one of the country's largest diagnostic care availabilities and repertoires. We have likely the country's largest cardiology group in our My Health group, and we're the largest license holder of specialty licenses for diagnostic purposes in the province of Ontario. These are highly coveted licenses that again, they're quite rare and they're quite difficult to come by, and we are the largest single license holder. And so we're very, we very much like what we're seeing with the growth of these businesses and how resilient they've been. Even in the case of Omicron, we have not seen very much, if any, impact. So very, very small impacts to our business, which again just demonstrates how incredibly resilient these businesses have been. Next slide, please. And on the virtual services, again, this is all of our practice management that we in our WELL-EMR group. We have and then all the different digital apps that plug into our EMR, and we have the country's only app marketplace for integrated EMR apps. That business is going extremely well for us. It is really helping us on a variety of fronts. It is helping us connect with the digital health marketplace in terms of all those different startups and digital health companies that want to connect into EMRs and be able to support patients and practitioners. We are really the only game in town in Canada as it relates to an open and transparent app marketplace. And we've Fireized our app marketplace, so it is now embracing the FHIR protocol, which FHIR is spelled FHIR, which is Fast Healthcare Interoperability Resources. This is a standard that Apple is really promulgating, and we think it is definitely the winning and most important framework. And we're the only major EMR that has adopted it so far. We have announced that we have adopted Apple Health Records, so we're working with Apple to be able to allow clinics and patients to be able to download their data onto the Apple Health Record app, which is that little app on your iPhone which has a heart. And again, we're the only major outpatient clinic EMR in Canada that does support that. So, and that's not something that we bought. We have a spirit of innovation in the company. We are doing a lot of interesting things, and I think that's something that is really helping support patients and practitioners. Our billing and revenue cycle management business, again, is growing extremely nicely. Organic growth there is probably in excess of 30%, steadily growing and profitable. And we did a tuck-in last year for them. And our cybersecurity business is profitable and growing, good, strong double-digit organic growth. And again, these are all incredibly important areas to support practitioners. And our business is strong, and we continue to see also just us building a lot of great relationships with practitioners. What's happening with us now is, as practitioners get to know the WELL platform, they're becoming curious about other areas where they can grow. And so a big part of our focus is how do we grow our share of the economic output of a physician by doing more for them and being more valuable to them. Next slide, please. I think what's really unique about WELL, again, is that we are really a health system now. We are an end-to-end healthcare service provider. And I don't think any of this is really being thought about in terms of our franchise value right now. And of course, there's other things going on in whether it's healthcare IT as a comp set or the overall macro picture, but we're very confident that this will come into play. WELL is a very, very consequential company, as I mentioned before. We have significant connective tissue and coverage over important areas of healthcare, from primary care to allied care to specialized care to diagnostics, to all of that connective interoperability that we now have as it relates to the practice management and EMRs and the digital apps, and of course all the e-referral stuff. We are the e-referral dominant leaders in the province of Ontario, given our Ocean acquisition. So our metrics are great, and I think you're going to continue to see us grow very purposefully, allocate capital very carefully. We think multiples, acquisition multiples are going to decline. We think that puts us in a great position. We did put out a shelf prospectus in the summer in anticipation of U.S. markets being strong and us potentially doing a U.S. IPO, but we saw what happened in the carnage in the U.S. markets, and we did that convertible notes transaction, and we don't need to raise any more money. So we are generating cash, and I think what you're going to see us do is continue to fill out this picture, but through de novo sites, through tuck-in acquisitions. And our long-term plan shows that without raising any more money, just with our own cash flow capabilities, just with our own organic growth, within 4 years, give or take a year, we will breach the $1 billion mark in revenue at similar EBITDA margins, over 200 million in EBITDA. So we're extremely proud of the platform we've built, and we think that investors are going to be extremely well served by understanding and investing and really trusting what we're building here with WELL. Next slide, please. Just to give you a sense of how strong the capital allocation has been, we deployed $14 million to buy 58% of Circle Medical. We're way in excess of now $30 million in ARR for Circle. At the time, we were about $4 or $5 million US in ARR there. And again, that's patient services revenue, but it's highly reoccurring. We're now likely over 30 million in ARR, Canadian dollars, and probably we'll be seeing tremendous growth rates this year with Circle. They're just really ramping up significantly. And last year they saw triple-digit growth rates, and we believe this year they could do the same. So we're quite excited about where that's going. With CRH Medical, when we bought this business, we bought it at really, if you actually just look at the top line EBITDA, it ended up being roughly around 6 or 7 times EBITDA. If you look at the adjusted shareholder EBITDA, it was roughly 8.8. And so we, since buying that business, we've grown the EBITDA. We've added to the platform. We have made a number of different, changes. We've made the business more digital. We've swapped out its revenue cycle management partner. We believe that we will be generating more than $45 million in free cash flow on a US basis, US dollars, before tax and leverage costs this year. So that platform is really performing for us. And what's great about this business is it generates a lot of cash flow, which again we can either use to continue to grow the platform or to invest in other areas that are faster growing. And then our WISP business, when we bought that business, we announced that it was roughly a $30 million ARR business. It's already up double digits on an organic growth basis. So we, that's another fast growth, digital business. It's an e-pharmacy business that's providing e-pharmacy products and services that are specifically focused on female wellness. That's reproductive and sexual health, and they've really zeroed in on a very important segment and are delivering excellent care. And there's a lot of commonalities between Circle and WISP, just in the way that they acquire customers, in the way that they service customers, but with different business models. Circle is getting paid by payers for delivering patient visits, whereas WISP is delivering products and services. This is why their margins are a little bit higher, because they're selling pharmaceutical therapies to those women. Next slide, please. And it should be noted that in those last 2 slides that I noted, that the Canadian and the US strategies are a bit different. In Canada, we are building a health system. We are building a comprehensive health platform for practitioners as it relates to digital capabilities to help them operate, or through our own patient services business. Whereas in the US, we're focused on those key areas, GI focused areas like CRH, and then of course there's the specialty telehealth and digital health businesses like WISP and Circle. The run rate of the business and the growth of the business, not just on an absolute basis, but on a per share basis, has been again nothing short of remarkable. Really, if you compare it, there's really no comps that come close to our growth. Again, I don't believe in growth on an absolute basis. I believe in it on a per share basis. And so I'm very proud of what we've done there. Next slide, please. And that's a story that we're going to talk about more from an investor relations perspective, because we want shareholders to understand that the issuance of stock to date has helped us grow our revenue per share, our EBITDA per share, our cash flow per share. And so, and now that we are at a point where we're generating significant cash, that we can continue to roll that cash into new cash making opportunities. We are now at the point where we have a virtual circle. We have a virtual cycle in terms of how we invest and grow the business. There we go. Yeah. So our Q3 was very strong. We're obviously past Q4. We felt very good about our performance in Q4. I believe we have never historically missed our top line and EBITDA, consensus estimates in the business. So we're, we feel very good about what we've done in the past, and that's certainly going to be our focus in the future. Next slide, please. And again, coming back and looking at what we've done as a business, again, we have patient tools, we have significant practitioner tools, we have this integration in these important on and off ramps from a referral and care continuity perspective between our primary care and specialized care businesses. And we're seeing network effects grow. We're seeing the business operate in an extremely healthy manner, and you know, we're very eager to continue to tell that story in the new year and demonstrate our earnings momentum. Next slide, please. In terms of our growth, again, you know, we are a strong cash generator, so we will be continuing to do tuck-ins without the need for more for raising more capital, and you know, generating millions per month, and have a strong cash reserve right now. So I think you're going to see us continue to fill out some of that white space, whether that be, you know, tuck-in clinics, whether that be starting new de novo sites. We just started a new de novo site leveraging the CRH intellectual property of their banding device to open a hemorrhoid treatment center in Toronto. We actually also bought into an existing one here in Vancouver. So now we have 2 of those centers in Canada. We expect that we're going to launch a number of new locations in Canada, all based on the CRH device, O'Regan, which is the #1 hemorrhoid banding device in the United States. It is the 7th generation patented FDA approved device. So a lot of people looked at CRH as just you know, an anesthesia service company, but it is a multi-service company that serves the GI practitioner. And one of the key services and products that they have is this intellectual property in their device. So I think you're going to see us take some of that intellectual property and unlock the value of it through establishing a clinical business that leverages that IP. So in the past, all they've done is sell that device to GI practitioners. And what we found in our research is those GI practitioners made hundreds of millions of dollars actually providing patient services. And so given that WELL does have that clinical DNA, we are looking to do that. And we think banding as a clinical service is likely over $100 million revenue business for us. And again, we have the best intellectual property in the business right now. So that's an important area for our growth. Next slide, please. ESG is very important to us. As I've said in the past, it's not a box ticking exercise for us. We have a fantastic ESG story. We're going to be talking about that in the coming weeks and months. Whether that be just, you know, our reduction of you know, emissions through the virtual care products and services, or the fantastic people metrics that we have and social standards that we have. We're going to be talking about that, and can't wait to share that with you. But if you're a WELL shareholder, you can be extremely proud about the culture, about the way that we lead, the way that we treat our people, and the way that we treat the environment. Next slide, please. Our management team is never been more excited. We have a strong team, and a number of us have worked together for many years, and the bench strength's very strong. So I won't go into it too much in detail because there's a lot of people here. But to say that I think we have some of the best, you know, operators in terms of and thought leaders in their respective in their respective areas in the country. Next slide, please. And our board is highly engaged and you know, really supportive and very helpful. And you know, for example, Tara ran the healthcare practice at PwC nationally. She was a board member on the country's only EMR certification and approval bureau, Ontario MD. Ken is a biotech CEO, ex-CEO, as well as a law firm owner. And so just the incredible knowledge that, you know, folks like that bring to the board. Tom and John are well known around the street, both on the buy and sell side, and have phenomenal reputations. Next slide, please. And so we know that WELL definitely caught some wind during the pandemic, and as far as our stock price is concerned, you know, it's operated similarly to our comps, and we've seen a downdraft. But again, as I mentioned before, we've never been more bullish about the business. We are you know, a lot of this downdraft in price or in the comps, you know, reminds me of what I read about Amazon when it went from 100 to 8, and Bezos talking about the share price not reflecting the company, and the company not reflecting the share price. And again, and I remember reading Bezos talking about how during that downdraft they experienced the most important intrinsic value enhancements that they had ever had in the company's lifetime until that point. And I really feel the same way. I think that WELL is really coming into its own. It's firing on all cylinders. I think shareholders can be really proud of where we're at, and I'm personally very excited about our results and being able to convey those results as soon as humanly possible. So yeah, I think we're on sale just like a bunch of other comps out there, and our biggest partners are extremely supportive. We talk to them all the time. They express their support. I know that they were buying in the market over the past few months, and I wouldn't be surprised if they are out there doing that now, although I can't be sure because they're on our board and they don't have a requirement to file. But we're very pleased, and we're not in any way discouraged based on what's going on, because we understand that it is not a WELL specific matter. It is really the downdraft of the markets, and specifically healthcare IT. As Rob, you mentioned, this was a kind of a pendulum swinging wildly in 2020, kind of swinging one way. Now 2021, it swung the other way, and I think we've had a bit of a continuation of that so far in 2022. Next slide, please. Just in closing, we have great technology. We have great sticky business, very resilient cash flows. We are a cash generator. We are a profitable company. The negative EPS is driven by non-cash items. A lot of them are driven by, a lot of IFRS specific stuff, like when you buy a company, and if you tie the earnout to the retention of the actual owner or operator, IFRS, for example, forces you to take that entire earnout expense and bring it into that entire earnout money, capital, and bring it into expense as a bottom line impact. We do that because it's the right thing to do in terms of keeping people focused when you're doing M&A and you're retaining owners. But again, those are the types of things that are hitting our bottom line and are not reflective of the true profitability of the company. So I think it's very important that people tune into analysts like Rob, who understand what those IFRS shenanigans look like, and that WELL is a cash generator. It is a profitable company, and we're very proud of what we're going to continue to do with those positive cash flows, and how we will create that very exciting flywheel that you see in companies like Constellation Software, who don't raise money and who don't issue stock. We're at that level now. Would we issue stock in the future? Perhaps, if there's something highly strategic for us, but we just don't see it right now. We are, it would have to be incredibly compelling for us to even, consider that. And I'm not even just talking about the price. The price could be a lot higher. We would still likely not consider it unless, again, it makes a ton of sense. Right now, just with our own cash and our cash flow, we believe we can drive, significant growth and profitability enhancement. I think we're pretty much done for the presentation. Rob, I don't know if you have any questions or thoughts.
Very good. Thank you, Ben. And we are cognizant of time, so I'm going to jump in with one question. In the marketplace right now, as you pointed out, it's all about value. And I think that equates very well with your rule of 30 narrative. Can you talk to the organic revenue growth and margins and how you balance the two? It's not just a measurement, but it's a way of driving the business.
Yeah, I mean, listen, why we picked rule of 30 is we analyzed companies that had met rule of 30 on a sustained basis for a number of quarters or years, and they did extremely well. I mean, this is something that investors really appreciate, and we also, in our analysis, what we also found is that there is interplay between those two items. Sometimes you may decide that you're going to invest some of that operating EBITDA margin to organic revenue, so that you can enhance your organic revenue growth, and vice versa. Sometimes you'll want to maybe squeeze a bit more cash out of the business, and you'll decide that you're going to lay off the organic growth, and that's what's really great about WELL today is we have both. We have the ability to grow organically, and double-digit organic growth for the kind of size of business that we have today, I think is really strong. And I think by segmenting the business in omni-channel and virtual, I think we're providing really good clarity in terms of how that's working. So I think it's going to be a function of the needs of companies, like in terms of being able to continue the great growth that they've got. Folks like Circle Medical and WISP and so forth, who have been strong growers for us. Understanding how far we want to push that growth and maybe take on sustained losses, even though again they have not been loss generators really. But when a company's growing, you really don't want to underfund that growth. You want to really unlock the value of that, and that's why founders and operators want to come to WELL, because we are thinking strategically about their growth.
Thank you. And just in closing, I really want to highlight the importance and the objectives with respect to your organic growth. It was very encouraging to hear the $1 billion revenue mark discussed with a 4-year time frame, give or take a year. Very encouraging. Discussion around margins, very encouraging. Nice to see you in the position of financial strength, and nice to see where you can thereby take advantage of the volatility in the capital markets to make tuck-in strategic complementary acquisitions. So with that, Hamed, we thank you and we congratulate you.
Thank you, Rob. Really appreciate the time and the opportunity to talk to the folks here. Thanks for giving us that platform.